All right, what's up, guys? I hope you're doing well. James here from jamesdforsythe.com. And so, kind of touching on another speech given by Fed Governor Michelle Bowman again, because she gave another speech that I went over a few days prior to this one. Like, I think it was literally 2 days. And this one's on a similar one. The previous one was on kind of community banking and the kind of we'll say problems community banks are dealing with at the moment. And this one's more on just kind of large scale, more on the larger end of the bank in terms of the size of the banks, specifically with their supervision and regulation. And we'll get into kind of the four principles for them, right? That she kind of follows in terms of like how she kind of, as she says, outlining her perspective, right, on bank regulation in general. So, with that being said, we will head over to the screen share of the speech. And so, the first of those four principles is basically that the bank regulation should be transparent, consistent, and fair, which it kind of lumps into the concept of due process and also building respect for supervisory practices. And basically, the whole point of this is to be more effective and encourage open communication between banks and supervisors because you really need that communications to really get anywhere, right? The second one would be striking the right balance between ensuring safety and soundness on the one hand and promoting acceptable and manageable risk taking, including encouraging responsible innovation, right? And so basically matching regulatory and supervisory requirements to the risks presented. And we've kind of touched on this concept a few times, specifically related to crypto, which she does get into later, right? And so we'll get that part as well. And so, kind of an aside, there are obvious risks from underregulation, and it is those risks that were addressed in the wake of the financial crisis 14 years ago, but sometimes overlook the significant cost to the economy and risks to safety and soundness from overregulation, where rules are not designed and calibrated to address actual risks. Like regulation is not cost free. That's something we've talked about a few times, so you really have to keep that in mind, especially with respect to the smaller entities, which is also something we brought up on the video of the problems that community banks are facing. So that's something to keep in mind as well. The third principle is that effective regulation and supervision needs to be efficient. Obviously, you want everything to be efficient, and basically, the banking system is so complex and there's so many things going on that you really don't need just the system itself or just the regulatory framework kind of slowing it down, right? At least any more than it needs to be, right? And this is where we get into kind of non monetary costs for regulations and that sort of thing. So, the final one is that the regulation supervision should serve a legitimate prudential purpose like promoting safety and soundness or reducing financial stability risk, right? Just it has to have a reason for whatever regulation you're doing in kind of the broader scheme of things, not necessarily just for more regulation. That's not a good reason, right? And so, to get in some more specific examples of regulatory kind of possible changes where we might see changes in the next few years or what it may be. The first being stress tests. I've done a few videos on this in the past, basically giving the results of the stress test and looking a little bit more into it. So basically, this is a critical element of this whole due process concept that she talks about. And so it's that the rules and supervision should be consistent among firms and over time. This can be a challenge because the variability in the business models of banks, especially among the largest banks, right? And so basically, these stress tests have been here since around 2013, and it's used to assess banks' capital positions and determine whether they have sufficient capital to both absorb losses and continue lending during stress conditions, right? And so right now, if I remember correctly, there's really kind of two main categories for the stress test and how they're graded. You basically have all of the major banks in the countries, we'll call them systemically important. And they pretty much look at them and see, how well would they hold up with a given, we'll say, liquidity crisis in terms of general kind of monetary terms, but also in kind of like financial assets. And they break it up into basically, is there a problem with the bank's function, or is there like would say like a market crash of some sort um harm the banks, right? And so can they withstand that kind of pressure? And they kind of test that. And this is where I guess chuckled to myself, because it's contrary to what the results from the test said. But although the stress scenarios are approved by the board and change in some ways that are predictable over time, or relate to changes in the underlying economy, how a scenario will affect a particular firm is not always predictable, right? And so basically blaming it on the year to year variations in the actual scenarios that they use to test the banks, because you can't do every single little possible scenario. Basically, the scenarios that they test are ones that have at least a decent, we'll say, decent probability of actually coming to fruition. But basically says that all the tests ran well. But according to the results of the actual test, a lot of the major banks in the United States especially failed one, if not both, of the stress tests, to where they were basically, we'll say, vulnerable to those kind of stimuli, right? Whatever. So the next section would be more capital, which is something that's pretty much more obvious with banks. I mean, we see this with like reserve requirements and that sort of thing. It's kind of a general argument. It's not that hard to think about it in terms of banking overall. So, this is an area where requirements were quickly bolstered without extensive analysis in response to the 2008 financial crisis, resulting in some cases in redundant methods of calculating capital and demands that firms of all sizes and risk profiles comply with the highest requirements, and the goal of efficiency dictates that over time this needs to be addressed. So basically, directly after the GFC, they pretty much did a kind of one size fits all in a way in terms of capital requirements, and that doesn't exactly work. Mostly because, and you'll see in the last sentence in this same paragraph, obviously expectations for the smallest banks with simple business models should not be equivalent to the expectations for large regional banks or for large and complex bank holding companies engaged in significant securities or cross-border activities beyond taking deposits and retail lending, right? And so really again, there's no cost-free regulation, right? And so the smaller banks can't afford to pay the costs, whether they're monetary or not. And for the same kind of, we'll say, degree of regulation, they don't have as much of a buffer as the larger banks do. And so that can run a lot of problems for like the small community banks, like we talked about in yesterday's video, sort of thing. And again, like right here, overregulation can restrain bank lending, which becomes a burden for individual borrowers and a potential threat to economic growth. You gotta, a one size fits all approach typically does not work for complex systems. And I'm pretty sure our banking and monetary system, especially on a global scale, is lumped in the complex system category, right? So then starts to talk about different indicators like the SLR, the Supplementary Leverage Ratio, and then the CCyB, which is the countercyclical capital buffer, which the Fed doesn't really use at the moment, at least according to the speech. She says that explicitly. Um, right here in practice, the board has not yet utilized the CCyB. Um, and then basically talks about how it might not be necessary, while having releasable capital buffers shouldn't necessarily be ruled out, in her view, after a decade of stress testing and recent real life stress experience, talking about the pandemic and all that sort of things, even the stuff that was happening directly beforehand. We have seen that the existing level of capital requirements has proven to be adequate for banks to deal with significant stress, right? And so Again, this is where it's kind of uh, counter in general to the results of the stress tests, as I've gone through in previous videos. I think I've done a couple on those, but regardless, basically, what's the other one? And then there's the stress capital buffer, which is somewhat similar, right? To go back onto bank mergers and acquisitions. And so this is kind of more, again, where the whole small community banks were kind of lumped in, that we talked about before, and also in her previous speech. And so basically, the factors considered generally include the competitive effects of the proposed merger, financial and managerial resources, future prospects of the merged institutions. Whoa, sorry. Convenience and needs of the communities to be served, compliance with money laundering laws, and effect of the transaction on the stability of the U.S. banking or financial system. And so this is where we kind of get into. There's also the index that they use. It's the HHI, and I have it's one of those names I have to be looking at to be able to pronounce correctly to actually say the index. It's something Hirschman, I think. Index, basically talking about how much it's kind of measuring almost the monopoly power of a market in a way, right? And so basically what they check is if this merger happens, does it increase the total amount of this kind of measure on that individual banking kind of market, by more than, I think the maximum level is 1800. And then I think there's also, if it increases that index by more than 200 or more, then basically they have to look more into it. If it doesn't fit either of those criteria, then it's basically like no further review is really necessary in that respect. I'm sure there's other parts of the review process, but in terms of kind of like the concentration of power and that sort of thing in that specific banking market, they're not too concerned about. Um, and it's also like something of like at least 60% are above that maximum value already. And so that's why you see a lot of press releases, at least I'm thinking, from the Federal Reserve's website when they're looking over bank mergers, where they're basically going a lot further into review, right? And this may be one of the reasons why. So there's that into it. And you have to keep this in mind, because, oh, a little bit more on the HHI index. I think obviously the closer to zero, the more of a free market it is in that respect. And I think the maximum is 10,000 for a complete monopoly, if I remember correctly. Um, Regardless, it's in that previous video if you want to look into it. I also put the links to the speeches and that sort of thing. And I always put the sources in there, especially if I remember, which is most of the time. I may miss one or two every now and then. But regardless, that's in there if you want to fact check or whatever. So, the reason why they look into this kind of merger stuff and why they kind of, especially for smaller communities, right? So a merger can have a significant impact on local communities in terms of the quality and availability of products and services. And so that's another thing that they look into with these individual banking markets, or what products and services are being offered and that sort of thing. What competition is there for that? Can these small banks compete? Is there enough competition in general? And this just kind of gets muddied up by kind of more specialized entities like specific mortgage lenders, or the farm credit system, I believe is what it's called, for farm loans, that sort of thing. And then you also have the kind of larger, more national in scope banks that can do essentially digital banking, to where you can bank wherever you want because it's all online, right? To where you don't need to go to a branch location to function in that respect, right? And basically, the reason they talk about this is the consequences of getting these policies wrong can significantly harm communities, in some instances, creating banking deserts, in quotes, especially in rural and underserved markets. She also did, I believe it was her, uh, meaning Michelle Bowman, did a speech on basically these banking deserts with respect to the Native American communities, especially out west. I believe it was her, but that's also a thing as well. And kind of the final. major aspect. They get into some other ones a little bit later, mostly like crypto and that sort of thing. But major aspect for banking reform, it seems, is this resolution planning or so-called living wills. And this is one thing that I hadn't heard of, period, before I started looking into these speeches and such. And I actually went to the source and downloaded a PDF of the U.S. code that I'm going to go over in depth because it's not too long and it's pretty, I think it's interesting, but because I've never heard of it before, I'm kind of curious on how it's applied, right? And so basically what this is the large banking organizations are required to submit a resolution to the Board of Governors and the FDIC, basically describing a plan for the quoting orderly resolution in the event of material financial distress or failure, basically having a plan for if the that entity goes under, right? And to basically help prevent bailouts in a way, at least that seems to be the hope or where they're kind of going with it. How exactly that's applied, we'll see, sort of thing. Um, Granted, who knows anymore. But this may also be a reason. I don't want to get too far off topic, but I was listening to a Wealthy on podcast with Danielle D. Martino Booth, right? And basically talking about maybe that's why the Fed is hiking so much, or is like, especially with the dot plot, and apparently how much emphasis Jay Powell put on the dot plot itself, which is something he typically doesn't do. He's kind of dismissive of it, it seems, generally. But apparently in the past press conference or whatever it was, he talked about it, or he referenced to it multiple times. I think specifically six, if I remember correctly, and which is rather, well, I guess we'll say out of character. And so basically, it seems like the Fed maybe just plan on hiking straight through a recession and like the complete disregard of a soft landing and that sort of thing. Allegedly, at least that's what I got from her point of view. And pretty much just screw the market, screw everything else. They're going to go. And I think this may be one of the reasons why is maybe he's trying to break the Fed put, which would be interesting to basically break that market psychology in a way. And essentially, this could be one of the reasons why is with these banks having an already set plan, and they apparently alternate. Or this is a proposal. My bad. Basically, it's proposed that the efficiency for these living wills will be helped by alternating between data intensive full plans and risk focused targeted plans. Right. Um, Basically having, I guess, a generalized plan and then one that's specific on specific risks, I guess, which would kind of relate to the stress tests and that kind of stuff. So I don't know. But with that kind of keeping in mind, there's also backstops, and you have to keep in mind that, I mean, the discount window is still a thing, right? It, even though it's not necessarily used because it's so stigmatized, but still, maybe that's what he's trying to force on the system again, sort of thing, is to have kind of that, I guess, old order destruction in a way. I don't know how to describe it really, but just kind of some initial thoughts and so on. And a little bit of an aside, I guess. So other areas, getting into the crypto assets, regulation and that sort of thing. I've done quite a few videos on this one already. Basically, they're coming after them, the whole like same risk, same regulation sort of thing. If a crypto asset basically proposes the same risks or just poses the same risks as some traditional financial asset, then it should be regulated by the same regulations as that traditional financial asset, whatever it may be, right? That's kind of the idea from it in general, right? And so basically, they don't want to stamp out the new technologies, um, but deems the best way to address these concerns and encourage innovation is dialogue between bankers and supervisors before and during the development and implementation of those technologies, right? So, really trying to understand the risks and keeping that open, transparent kind of channel of communication between banks and supervisors to really kind of keep that in mind it seems. So, oh, this was kind of a cool fact that I didn't really know about, specifically tying it into mortgages. So, to quote explicitly, however, it is also an area talking about the crypto stuff where there has been and continues to be intensive consumer demand, and we should consider whether there is a stabilizing role for banks to play in intermediation or ensure that the competitive landscape does not create a financial stability risk by pushing activities outside the banking system, as we have seen with the mortgage industry, right? And so basically, would implementing would banks becoming major intermediaries in the crypto space, whether that be through their own stuff, just basically helping with trading, whatever. If you could have specific crypto denominated accounts, I don't know. I'm just throwing stuff at the wall of how they would implement that sort of thing and basically become major intermediaries in the crypto kind of ecosystem. Would that smooth out the kind of volatility we see? And that's just kind of a proposal, it seems, in a way. It's not necessarily taking a value judgment on general. It's just kind of something to provoke thought. And if you guys have specific kind of comments or concerns about that specifically, feel free to put them in the comments and have a discussion. It's kind of the whole point of these videos in general. So just something interesting. And I also didn't realize if this especially it's especially kind of applicable to like the mortgage industry, right? Um, or at least that's where it's a good analogy, I guess I'll say. So, where we have established basically going on back onto the supervision aspects of things, um, she wants to I don't withhold's not a good word. Wants to basically uphold the precedents that they've already established and respect them because basically that's one of the only ways, or that's a major way, I'll say, that banks can um, make their business decisions. I mean, if the rules are always changing, and even like think about it like a board game, if the rules are changing every 10 minutes, you can't really play. And that's why games work because the rules don't change typically. Um, or at least that's the hope, right? Obviously, I'm not going into the whole argument on the current kind of looking into the past few decades, or I guess you could argue all of financial history. It's not really the point of the video. I'm just kind of trying to draw that analogy of where she's kind of the concept she's attacking in the speech, in this part of the speech, I'll say, right? And kind of finally, just to give a little example of increasing transparency and stuff. So, to take, for example, the supervision criteria implemented by the large institution supervision coordinating committee, there's always so many acronyms. Um, it just never mind. That's a whole nother rant. But currently, these materials are not public. Basically, what these supervision criteria are, and so making these materials public would not only improve transparency, doing so would also provide some assurance to the banks subject to them that they are being held to the same supervisory expectations as their peers over time. Without this clarity, it is far more challenging to build trust in this aspect of the supervisory process, right? So, kind of giving us a specific example of to why it's important to have this kind of transparency in the system, right? So, a lot is going on in kind of the whole I don't know if I necessarily call it banking reform, but just kind of I guess kind of because the whole point is changing banking regulation or at least improving it, right? Maybe you could argue it's more of fine tuning and not really blanket reform. Obviously that may be that's a completely separate topic and we'll probably attack different concepts and that sort of thing. But regardless, that's it for this speech, and I'm going to leave this video here. So, with that being said, I hope you guys have a good night, and I will see you on the next one.